Friends, you are welcome to my YouTube channel AKD Global Education. Today, I shall discuss the method of knowing financial health with the help of financial ratios. The personal financial situation of an individual or a household primarily refers to its ability to manage its current and future needs and expenses. The income available to do this may be drawn from salary, from a business, from profession, from the assets created over the time. Typically, assets are created to meet the future expenses. Loans are used to meet expenses and to create assets. If income is inadequate to meet all needs, this creates liabilities for household. The efficiency with which the interplay between income, expenses, assets, and liabilities are handled by the household determines its financial situation or health. Just like company, to know the financial position of individual or household, financial ratios shall be used to know financial health. These financial ratios are calculated using the income, expenses, savings, and investment data. Important financial ratios like saving ratio, leverage ratio, solvency ratio, liquidity ratio, financial assets ratio, debt to income ratio shall be discussed in this video. Video is going to be very important and interesting one. Don't skip and watch till end. First, I shall discuss savings ratio. Saving ratio is the percentage of annual income that a person is able to save. This is calculated by dividing yearly savings with annual income. Suppose your annual income is 5 lakhs, annual saving is 90,000, then saving ratio is 18%. Savings is not limited to money that is retained in savings bank account. It includes money invested and also contribution to PF by self and company. For ideal saving ratio, please view my video on 8 golden rules of personal finance. Next, I shall discuss leverage ratio. This is a measure of the role of debt in the asset buildup. It is obtained when total liabilities is divided with total assets. Let us understand with an example. Suppose you are having assets like house of 30 lakhs, investment and bank balance of 15 lakhs, PF of 5 lakhs, total asset is of 50 lakhs. Loan was taken rupees 20 lakhs to purchase the house, current outstanding is of 10 lakhs. Other loans of 8 lakhs, credit card dues of 2 lakhs, total liability is of 20 lakhs. Then leverage ratio is 20 by 50, which equals to 40%. Higher the ratio, more risky it is for the individual's financial situation. A ratio greater than 1 indicates that the asset will not be adequate to meet the liabilities. Investor needs to look at the leverage in the context of debt servicing capability. Next, I will discuss solvency ratio. It can be calculated by 1 minus leverage ratio. Higher the solvency ratio, stronger the investor's financial position or health. Next, I shall discuss liquidity ratio. Liquid assets are those assets that can be easily converted into cash at short notice to meet expenses or emergencies. It is normal to calculate the liquidity needs as expenses that an investor will incur over the following 6 months, which includes loan repayment also. Liquidity ratio measures how well the household is equipped to meet its expenses from its short-term assets. It is calculated by dividing liquid assets with monthly expenses. A ratio of 4 to 6 indicates a comfortable level. Let us understand with an example. Suppose you are having liquid assets like saving bank deposit of 2 lakhs, short-term FD of 2 lakhs, open-ended liquid mutual fund of 3 lakhs. Total liquid asset is 7 lakhs. Monthly expenditure 1.5 lakhs. Liquid asset is 7 divided by 1.5, which equals to 4.66. Liquid ratio is around 6 indicates a comfortable position. Higher ratio would indicate that a larger portion of the savings are held in liquid assets and would be earning low return. This will affect the ability to meet the long-term goal. Next, I shall discuss financial asset ratio. Assets are broadly classified as physical and financial assets. For details, may please view my video on investment ideas. Financial assets are generally income-generating investment. They have the advantages of greater liquidity, flexibility, convenience of investment, and ease of maintaining. Suppose you are having total assets of 50 lakhs, out of it you are having financial asset of 20 lakhs, the financial asset ratio is 40%. A higher proportion of financial asset is preferred especially when goals are closer to realization like retirement. Then there is a need for income or funds to meet the goals. Next, I shall discuss debt to income ratio. Leverage ratio, which discussed earlier, measures the extent of debt used in asset acquisition. Debt to income ratio is an indicator of the individual's ability to manage current obligations given the available income. The parameter is also used by lenders to determine eligibility for additional loan. Suppose you are having monthly income of rupees 1.5 lakhs and has loan commitments of rupees 60,000 per month, then debt to income ratio is 40%. A ratio higher than 35 to 40% is seen as excessive. A large portion of the income of the household will be committed to meet loan obligations if debt to income ratio is more than 40%. This may affect their regular expenses and savings. Obtaining loan in case of emergency may also become difficult. In concluding, I can say that everyone needs to calculate personal finance ratios periodically, say once a year, and compare with past numbers to identify trends. This will help to identify areas where corrective actions are to be taken to improve. With this, I complete today's video. Don't forget to subscribe my channel. Please like my video and share as much as possible. Thanks for watching my video.